So out of the traits of successful traders, we can identify 3 important common trading problems. The first is performance anxiety. Performance anxiety occurs when our thinking about a performance interferes with the performance itself. If I'm worried that I'm going to fail a test and fail a course and fail out of my program in school, how's that going to affect my memory for the material I studied? That's performance anxiety. If I'm worried that I'm going to forget my lines when I'm in a play, that's going to affect my performance. Thinking about the outcome of a performance interferes with the natural act of performing. 90% of all sexual performance problems are due to performance anxiety. Well, it happens with traders. If you start thinking about your profit and loss, and you think about how much you lost last week, or you think about how much you need to make, part of your mind is thinking about you and money, and part of your mind is focused on markets. But to perform well, you have to be absorbed in the doing. You have to be absorbed in the markets. It's not about you. The markets have nothing to do with you. It's not about your profit and loss. But when we get caught up in negative thinking about our performance, it interferes with our reading of markets. And we start to trade for reasons other than objective opportunity. A second problem, impulsivity. Impulsivity occurs when we act before we think. And most often, we'll be talking a little bit later about triggers, most often it's triggered by frustration. You lose some money on a trade, and what's the first thought that goes through your mind? You want to get it back. And now all of a sudden, you're trading for revenge reasons. And out of frustration, you put on another trade, and it's a terrible trade. You get a horrible location on the trade, and you lose again. Very different than really mapping out in your head what markets are doing and planning a trade around that. And finally, a third problem that we commonly see among traders, a failure to adapt to changing market conditions. I cannot tell you how many successful traders I've known and worked with who stop becoming successful because they try doing the same thing again and again and again under different market conditions. There are some times where following a trend works, and there are some market conditions where trend following will not work. Markets move differently at different time frames. There's much more algorithmic, computerized trade close to the market on a very short time frame from the market makers, especially in the stock index products. That's changed how markets move. How many of you have observed how markets have been moving lately at the end of the day, stock markets? Holy crap. What happens in the last few minutes of the day? All of a sudden, the volume expands, the volatility expands. That never used to happen in that way. If you do not adapt to those kinds of changing conditions, you're toast. Because you'll be fading something, and it will move much more against you than you could have ever previously have expected. These trading problems and challenges boil down to an issue of control. Most psychological challenges with trading boil down to either being under-controlled on one hand or over-controlled on the other. On one hand, we have the impulsive trader, that's the under-control, who loses control out of frustration, out of a fear of missing moves. How many of you have chased a market because you were afraid it was going to move without you? I mean, we've all done that, right? I mean, and you get the absolute worst trade location and the thing just reverses against you. It's very frustrating. That's under control. The fear is controlling you. The fear of missing the move is controlling you. You are not controlling your own performance. The trader who is under-controlled, it's almost like they have attention deficit disorder. They lose their focus, and they lose their ability to be governed by rules. On the other hand, we have the over-controlled trader. The trader who becomes so fearful and hesitant that they freeze. And so there's opportunity there, and they won't take it. I had a situation just recently where a trader had fantastic ideas on the day. And in fact, he emailed a bunch of his colleagues at the firm what he was seeing in the market. Great ideas. They made a bunch of money off the ideas. They came over to him and they said, "Oh, you really nailed that one." Well, what did he do? He never got into those positions. He was emailing. He had all the right ideas. He never got into it. Well, he couldn't get quite the right price, and maybe we'll go down a couple more ticks. He's so anxious about losing money that he never took advantage of the opportunity that he had identified. There's such a need for safety that he couldn't take risk. Attention in that situation becomes self-focused, and so they're not absorbed in markets and not able to act upon what they see. Most trading problems boil down to the issue of being under-controlled on one hand or over-controlled on the other, or sometimes people will oscillate between the two. They'll become hesitant and fearful. Then they'll finally make a trade. They'll lose money. Then they get angry and frustrated. And then they get impulsive. And then they lose too much money. And then they get hesitant and fearful again. And it will cycle around. So much of trading psychology boils down to techniques for establishing control under conditions of impulsivity on one hand and anxiety and hesitance on the other. This is a huge, huge idea. It's something I emphasized in my first book, and it's really a cornerstone of the work I do with traders. The trading patterns that get you into trouble, the trading patterns that get me into trouble, are state-dependent. In other words, they only show up when you are in a particular state of mind or body. This is why talking to a coach or writing in a journal often does not work. Because you are in a nice, calm, focused state of mind when you're talking to your coach or when you're writing in your journal, but under the conditions of actual trading, you're in a completely different state and new patterns emerged. The reality is our behavior is patterned. Just like markets have their patterns, we have our patterns. And our patterns are associated with certain states. It might be a state of anxiety, a state of frustration, a state of boredom. Our patterns emerge only when our bodies and minds get into these states. That's why at the end of the day, how many of you have had this experience? At the end of the day, you look back on it and you look back on your trading and you say, why did I do that? WTF, what? I knew the market wasn't going down. Why did I sell it there? It's because what you know when you are in a calm and focused state can be very different than what you can access when you're in that anxious or frustrated state.